Rose, Longwood Currency Trading. Good afternoon. It's a beautiful mid-June 2021 afternoon. I'm outside to do video as I try to get outside as much as I can. I've been inside all day looking at stock markets and ETFs and currencies and doing some continuing education for myself on macroeconomics and enough. Stop. What's causing all this? The stock markets currently are, what I'm going to be talking about today is the safety of the currency markets. My opinion, I'm not giving any fucking financial advice to anybody. Calm down. On my website at longwoodcurrencytrading.com, on the currency trading page, there are 7 reasons. I list 7 reasons why I like the currency markets, the Forex market, as a trading vehicle. One of those has to do with safety, and that's the liquidity of the market. It's the largest market that's out there. At $6.6 trillion, it absolutely dwarfs all of the stock markets in the United States on a daily basis. That liquidity obviously is not going to be in Turkish lira and the, I don't know, Cambodian currency or whatever it is, even though they have currency or economic transactions between them. There are 6 major currencies, and probably 85% of the total market transaction value, dollar value, will go through the majors, and probably 80% of that 80% is going to be in euro, USD, pound dollar, dollar yen, something like that. Probably, I think euro USD is the largest transaction-based part of that. It's a it's a shit house full of money, and so that gives you the safety. I mean, if you don't know how to trade, whether you're trading currencies or commodities, stocks, old tires, real estate, doesn't make any difference. You're going to lose your fucking money. You got to know what you're doing. If you do know what you're doing, you can probably be safe in anything that you trade. If you're looking at financial vehicles, you want absolute safety. You can get U.S. Treasury bills, for example. 10-year notes, 1.5% today. And that's up. Characteristically, the stock market will give you 7 to 9% a year. Let's call it 8% averaged out over 20-year tranches of time. Commodities will do basically the same thing. Real estate will do the same thing. That's about what you're going to get averaged out over long periods of time. You know, unfortunately, if you're in something like real estate, like I was for 40 years, I went through 4 horrendous crashes that took the value of my real estate down 30, 40, 50%. I remember one time I went to the bank to get a loan on one of my properties, and they felt that the property value had gone down 70%. Which I thought was stupid, but we're not going to argue about that. The problem is that in real estate, you get these massive drops. I mean, I'm just not pulling numbers out of my ass. When I owned a condo, I think I gave this example in one of the other videos that I did. I had a condo. This is 6 years ago, 2016, 15, something like that. It was worth $250,000 a year before that or so, 2 years before that. And then we had this big drop in value, and it went down to, I had an agent come in and take a look at it just to give me an idea. I didn't want to sell at that particular time, but I just wanted a value as to what it would be worth. It was $150,000. It dropped $100,000. What was that, 40% or something? So this stuff is real. These drops are real. So the real safety is not in the asset. Is real estate safe? Yeah, it's safe, but is there something safer? Well, what creates the safety? The safety is created in how quickly you can get out. You can't get out of real estate. You have to be willing to take a bad hit, and for about a 5-year period or 6-year period, in order for that to get back to where it was or just below where it was. The condo that I ended up selling for, I waited until it came back up, and I got a couple $100,000 for it. I now understand it's worth $310, and that's 5 years later. So, in 7 years, it went from 150 to 310. So it went back up the 40% that I lost. But look at the differential that the thing had to grow. And that's only created because of the lack of supply of new housing and the tremendous demand. It's just driving things up like crazy. You might not hit this kind of perfect storm for 20 years. Who knows what happens when the real estate market breaks? But we're not talking about the real estate market. We're talking about the currency market. But I think it's interesting to compare the two markets, because almost everyone that you know of is going to say real estate is safe and the currency market is unsafe. And yet the currency market will move on a cash basis less maybe than real estate. It's the leverage that gives you the tremendous advantage in the currency market, as opposed to the loss, what you can expect. But you can get out right away. Where in the real estate, you see the real estate starting to crack. It goes down really quickly, and you just can't get out. It goes up very, very slowly, but it goes down really quick. Currency markets, the stock markets, bond markets, they all do the same thing. It takes them a long time to go up and a very short time to go down. And that's why I like to be a day trader, because the most I'm going to be out is a day's worth of hand-wringing over whether the market is turned around or not. Now, in a day, a major pair could lose 300 pips. I've seen pound dollar go 800 pips in under a week. That's a lot of move, right? That's just craziness. And yet, you can get out any time. And if you're wrong, you can always get back in. You can't do that in real estate. And that's the burden that I bear when I come into the currency markets, is I'm so used to dealing with the downslides and then the claws back up, and how to maximize the reclaw back up. In currencies, if you're going to take a big hit, you can average in as the thing goes back in your favor. But again, because of the leverage, just a small retraction will take that doubled up position and show just tremendous losses. And you're not sure whether that is a true reversal or simply a retracement of a temporary retracement of price until it continues on back on the track that you need it to go on in order to recover. So to play those games in the currency market just isn't advisable. And I know a lot of guys that play that and they get away with it. And the reason they get away with it is because they do so well in their general trading. They have a very high win-to-loss ratio, that when they do get their really far-out stop hit, it's just really a small percentage of the number of pips that they've gained. So you may gain 150 pips on the ride up. You may gain 300 or 400 pips by trading in and out and adding lots and all that position. But the time that you lose, you hit a 20 or 30 pip stop, far out stop, and you lose, I don't know, 100 pips, depending on the size of your lot size. Oh, dropping my phone here. So you can manage that risk even by doing that. But in currencies, if you get that flip wrong and you're trying to average down, as they say, or if you're averaging in on the way back up, if you're not a really good trader, you're going to get caught more times than you're going to have that work out in your favor. You're going to get hurt. So the control that you have in the currencies is you go in a little light. If it goes against you, right away get out. Take the small hit. If it goes in your favor, scrape a little bit off as it goes in your favor, and then move your stop up to break even. And then as it goes up a little further, start adding into the position until your trailing stop takes you out. It's a really simple methodology. But you can't do it if you're stupid. You can't do it if you don't understand the trading process. If you do understand that process, that's the safest investment vehicle, I think, that you can make. A long time ago, back in the 70s, I invested in a beat-up Porsche because I had a friend of mine who was a mechanic and was really good in that stuff. Well, we could fix this thing up. I'll put up the money, you put up the work, we'll split the profits 50-50. Well, it took 2.5 times more money than we thought to fix the thing, and about twice as long to sell as we thought it was going to take to sell. And though we ended up making money, the percentage gain, even as a single person, over the time and the risk was inconsequential. It was stupid. We could have gone into the stock market for far less risk. Because if you screw up the renovation on a car, and I mean, you know, it may not sell at all. And so you could lose the whole thing. Whereas if you're in a stock and you start losing money, you're the one that's in charge of how bad that's going to get. So you either stay with it and hope it comes back, or maybe you're just playing the long game and hope it comes back, or you get out. Because you can always, again, the thing is with currencies, you can always re-enter. You don't even get those odds playing blackjack. You know, if you play pass line craps in the casino, those are your best casino odds, 1.34% against you, I think. Which means if you sit at the table long enough throwing craps, you'll lose 1.34% of the total money that you've bet over a period of time. So if you're playing $1, the dice are thrown 60 times an hour. So, you know, you bet $1 each time it's thrown on average. You make, you've bet $60 over the course of that time, and you lose 1% of that. You lose $6. So, a little over $6, right? 60 cents. I don't know how to do the math, but you get it, right? The thing is that when you put your money down on the craps line, you can't take it off. Once you put your money on the table, it's gone. You're going to win, you're going to lose. Now, if you see that the dice are being thrown a certain number of times and it's getting close to the number that you need it to hit, you can always do insurance and all that other kind of crap. And in blackjack, you can split the cards. So there's insurances that you can take, but again, if you don't know what you're doing, the long and the short of that is you can't take any money off the table. Once you commit money to the table, once you've put your ante in on the poker table, or once you've thrown your bet in, you can't take it back. You either win or you lose. In currencies, you can always take it off. I could put it on, oh, that's a mistake, take it off. Oh, I'm going to go back in, and take it off, and take it off. And so you got to realize that if you go in and out right away, you're going to pay the vig. even if you get it's the same price, you're going to pay the VIG, you're going to pay the spread, which is 1%, 1.5, I mean 1 or 1.5 pips. So it just has to move a little bit in your favor in order to make up the VIG, and a little bit more than that makes up for maybe the 2 or 3 VIGs that you had to pay when you got out maybe prematurely, and now the thing is running in your favor. And if it doesn't, you get out again. So you've accumulated maybe 4 small losses that might be the equivalent of somebody taking a 20 pip risk. But you've played the game 4 times. You've given yourself 4 times in order to make that go. So if you've got a good win-to-loss ratio, you won't lose 4 times, right? I think when you get educated, and if you have somebody standing next to you at the table, or at least counseling you or mentoring you in what you're doing, I think your win-to-loss ratio is better than jump ball. It's got to be better than 50%. And I would think when you finally figure things out, your win rate's got to be 60%. So you win 6 and lose 4. Now you could win 9 times out of 10 and still lose money. I mean, so the fact that the first thing you want to do is get to that 60-40 win-loss ratio. Don't worry about the amount of money that you earn. Just get to the 60-40, and then figure out how to make money. I mean, they're just steps that you need to go through in your trading. But it's like anything else. If you're going to buy stocks, you'd have to understand value investing, read 10K reports, and God forbid you don't listen to your broker. Or buying real estate, you got to understand the financial impact, how much you put down. There's a relationship of the interest rate that you're paying on the money that you're financing, and the condition of the building. I mean, there are all kinds of rules. You can't just go, well, I'm going to go buy that piece of property because maybe somebody's going to put a cemetery next door. Yeah, I mean, you just don't walk into any investment blind. You have to know what you're doing. So if you did know what you were doing, as I do in so many different disciplines, commodities, stocks, stock options, bonds, real estate, 40 years in real estate. I traded stock options for 4 or 5 years. I know what the problem with that stuff is. So I've got a diverse background of investing over many different types of products that are available to all of us out there, although maybe the real estate is a little bit out of everybody's reach. But if you know how to do that, you can get into it. I consult on that to some folks that are starting out, and they just want to know some of the basic rules of what to do. You know, I work with some folks on a consulting basis for that. But you still have to know what you're doing on anything that you do. So learn those basic fundamentals in the currency market. And you're watching this channel because you're interested in currencies, right? So figure out what you need to learn in order to determine what you're going to have to know in order to be safe. That's the whole thing. Be safe. And once you can be safe, then you can shoot the potatoes and go for the big numbers on the trading, because you know you're disciplined and you know when to get out. The problem in me coming from real estate into currencies is that I had time to work through the problems that real estate presents. In currencies, you don't. As soon as you recognize you're wrong, you've got to get out. You go, well, I think I'll hold on for another 10 pips. Oh, well, it'll turn around. Then another 5 pips goes by. Well, look, every 5 pips in a full lot is $50. And when you're trading multiple lots, if you're trading 3 full lots, it becomes $150 every 5 pips. So, you just have to, you got to get out when it's against you. Because every time you get hit and you get knocked out, you don't just say, oh, well, there's one of my 4 losses out of the 60 that I'm looking at. You can't look at it that way. You lost for a reason. Step back. Don't just go back in and trade. Step back from that trade. What was the entry mistake that you made? You got to figure that out because it was a mistake. And the mistake was, it's very simple. You got in too soon. That's the reason why your entry mistake is going to be primarily wrong as a beginner. You got in too soon. Your next thing to learn after that is, after you learn how not to get in too soon, you got to learn, does the price have the momentum to get to whatever my price target is? And then the next thing is you got to figure out what a reasonable price target is. Those are the steps that you go through to learn how to trade currencies, not pay somebody $2,000 to teach what a fucking pip is or how to do limit orders. For God's sakes, these people that are teaching this stuff are just ripping everybody off. It's stupid. I don't even bother with that stuff. You're never going to learn that stuff from me. I'm not going to waste your money or your time for that. I charge a lot of money for what I know. And what I'm doing is I'm showing to you right now. These are the steps that you have to go through or learn before you even get into trading real money. Treat this with respect because it's, in my opinion, the currency market is the safest place for you to try to increase your net worth or add substantially to your income level. If you can make 20% a year on a $30,000 bank, that's $6,000 a year that you're going to make. And if you're making $30,000 or if you're making $60,000 a year, that's a 10% increase in your income, and your boss isn't going to give you that. Don't think that you're going to come into the currency market and make 80% a year. Are there people making 80% a year? Yeah, there are people making 100% in 2 months. Well, but that's not you. I took a $5,000 account and doubled it in 4.5 months. Could I do that again? Well, I don't know, maybe, but you got to take more risks. Why bother when you can just pick away at it and pick away at it? You're not trying to take a $10,000 account and turn it into a $100,000 account. Well, you could if you traded for 10 years or 5 years or something like that. The only way you make a lot of money is if you have a lot of money. Take a $100,000 account, and what's each pip worth? It's worth a lot of money. I don't know. If you value your time and you don't have a lot of time or expertise in getting involved in fixing up old cars or investigating the fundamental analysis in the stock market, getting involved in real estate, dealing with freaking tenants. You're a tenant? Look what a miserable son of a bitch you are. You think I want to deal with that? I can't even imagine. Take a look at the currency markets, but look at them maturely with a proper attitude and what you're going to need to do in order to build your skills so that you can say with certainty that the currency markets are the safest. Again, my opinion. And that might be just worth a cup of coffee to you, or it might be worth thousands of dollars for you to help. I don't know. That's your decision to make. You don't have to even talk to me. Just do some reading, do some study, and figure this stuff out for yourself. I had to do that. It's just that it cost me $50,000 to learn how to do it because I got it wrong when I started. Because all I did was read books and watch videos and thought that that was the straight scoop. And I'm a pretty bright guy and came out of 40 years of real estate investing. And I read probably 120 or so books on in currency trading alone, and maybe 200 or 300 in general finance and business and stock market and all that commodities and all that other stuff. So I should have been able to do it. But there are just certain nuances that if you can, in the currency market, that if you can just learn what those nuances are so that you can be aware of where the landmines are, you do all right. But it does take some work, it does take some studying, and my advice would be get a mentor to help you, and don't even ask him what he's going to charge you. As long as you know he's not going to charge you what the value of a pip is, or what the head and shoulders fucking patterns are, or all this other shit that these people are teaching you, okay? Peter Rose, along with Currency Trading. Have a great day. Have a great trading day.